In today's episode, I'll talk about three very interesting stories. In the first story, I'll talk about Paytm and how it has had a bit of an eventful quarter this time. In the second story of the day, I'll talk about rural India and how this space is now once again moving towards agriculture as a source of income. And in the third and final story of the day, I'll talk about what investor Druckenmiller has to say about America's economy, which by the way could have great ripple effects across India as well. Welcome to the Daily Brief Show by Zerodha, where we cut through the noise and simplify the biggest news in the financial markets in a way that is one level deeper as compared to traditional news channels. I'm your host Anurag Bansal, and today is Wednesday, the 23rd of October. In the first story of the day, let's talk about Paytm. Look, this quarter has been a bit of an eventful one for Paytm because of its issues with its banking unit, PPBL or Paytm Payments Bank. Now, in case you've missed it, the Reserve Bank of India a couple of months back had taken very strict action against Paytm Payments Bank and barred it from onboarding any new customers. This means that PPBL could not add any new users to its banking services, which in a way is a big deal because this was one of the key ways in which Paytm as an entity attracted new customers who then also used other services like UPI payments or loans. The reason for this crackdown by RBI was that PPBL apparently had lapses in two very crucial areas. First was security protocols and the second one was KYC protocols. Now this setback hurt Paytm's growth quite a fair bit because amongst other things, it also allowed competitors like PhonePe and Google Pay to capitalize on this opportunity and therefore capture a larger share of the UPI market. But the thing is, despite all of these challenges, Paytm managed to turn a profit of 930 crore rupees just this quarter. And if you're wondering why, this is largely due to a one-time event, which is the sale of their ticket booking business, Paytm Insider, to Zomato for 1,345 crore rupees. Now, Paytm sold Insider because it was not quite a core part of their business. So they decided to sell it off and focus more on their main services like payments and lending. Now, by selling this part of the business, Paytm also happened to boost its cash reserves, which now stand at a massive 9,999 crore rupees. This sale also allowed Paytm to bring in money and sharpen their focus on areas which truly drive growth for themselves. But that said, even if we leave aside the money part, Paytm's performance has still improved. Their EBITDA loss has dropped down to 404 crore rupees, right from 792 crore rupees in the previous quarter. Now with that said, moving forward, one of the very key strategies that Paytm is focusing on is its lending business. To help this particular business grow, Paytm has also introduced something called the Default Loss Guarantee or the DLG model. Now if you're wondering what this means, basically when Paytm connects lenders like banks with borrowers, it promises to take on some of the risk. If the borrower fails to pay the loan, Paytm agrees to cover a part of the losses. In a sense, this encourages banks to hand out more loans through Paytm's platforms because they know that Paytm will absorb a part of the loss if things happen to go wrong. Now, so far, this strategy seems to be paying off for Paytm. In the second quarter of FY 2025, Paytm had disbursed 3,300 crore worth of loans to merchants, which is a very significant jump from 2,500 crores in just the previous quarter. What is also interesting here is that 50% of these loans went to repeat borrowers. This means both lenders and borrowers seem to trust the system also. But the thing is, there is also a pretty obvious flip side to this problem. If too many borrowers start defaulting on their loans someday, Paytm will have to absorb these losses, and this could eventually hurt its future profits quite badly. Now the thing is, while Paytm's lending business is gaining steam for sure, its UPI services have taken a bit of a hit. Paytm saw its monthly transacting users or MTUs drop from 7.8 crores to about 7 crores this quarter. Now the reason for this comes back to the RBI crackdown on Paytm Payments Bank, which like I mentioned earlier also affected related services like the UPI. But once these regulatory issues do clear up, Paytm is expected to ramp up efforts in order to regain their lost market. But for now, UPI as a segment does remain a challenge for Paytm. But that said, despite all of these struggles, one key area where Paytm continues to do very well is merchants. More than 1.12 crore merchants now use Paytm services, and Paytm has found creative ways to make money from this audience base. One of the more interesting innovations is the Soundbox device. If you have ever been in a store that uses Paytm, you've probably heard some device that announces payment confirmations out loud. Now, as of late, Paytm has been using these very devices to also play ads for brands like Coca-Cola, Misho, and also Dabur. This has helped them turn a simple payment notification device into a platform that also generates additional revenue for themselves through advertising. But the thing is, whether or not people will receive this very well is something we will still have to wait and watch on. Now let's move on to the next story and talk about rural India. Now the reason why this is so important is because while we talk so much about India's rapid urbanization, the truth is that the core of India's identity still lies in its villages. Mahatma Gandhi once said, "The soul of India lives in its villages." And even after all the advancements in technology today, this statement still remains very, very true. About 65% of India's population still lives in villages, which makes it a very, very important part of our economy. Also today, agriculture still continues to play a very central role in these regions. But the thing is, to truly understand the country's rural economy, we need to dig a little deeper into how these communities earn, spend, as well as manage their money. And this is exactly where NABARD All India Rural Financial Inclusion Survey, or NAFIS, comes in. See, this survey gives us a detailed look into the financial landscape of rural household and helps us understand how things are really shifting. The most surprising trend in this report is the number of people returning to agriculture. See, for years, we've seen a steady decline in farming as rural populations have migrated to cities for better opportunities. But between 2017 and 2022, the percentage of rural households that engage in agriculture jumped from 48% to 57%. And a big part of this shift can actually be traced back to the COVID-19 pandemic. See, during the pandemic, a large number of migrant workers had lost their jobs and they had no other choice but to return to their villages. With very, very few alternatives, many families eventually turned to farming once again, even if it had not been their primary livelihood before. Now, this reverse migration drove households back to agriculture as a fallback, not as a choice, but in a way out of necessity. But here's the thing, even though more rural households are involved in farming, their main income still does not come from agriculture. In fact, more than half of agriculture households now earn a majority of their income from non-agriculture sources. Jobs like wage labor or roles in the private and public sectors are playing a massive part in rural earnings. Now, if you zoom out further and include all rural households, both agricultural and non-agricultural, only about 27% of the total income actually comes from agriculture. To give you a contrast, 37% of rural income now comes from non-farming jobs, especially government or private sector employment. So while farming does remain an integral part of rural life, the reality today is that the rural economy is diversifying very fast and people are increasingly relying on other income streams. So then the question here is, why exactly is this happening? Look, one of the major factors here is the shrinking size of land holdings. In 2017, the average rural landholding was 1.08 hectares, but by 2022, this number dropped to just 0.74 hectares. See, as land continues to be divided and fragmented, it is becoming very hard for families to make a living from farming alone. So therefore, farming is becoming less productive and more costly, which is eventually pushing households to find additional sources of income beyond agriculture. But that said, there is also some very interesting news here. Rural incomes have lately been on the rise. Between 2017 and 2022, the average household income in rural areas grew at a nominal compound annual growth rate of 9.5%. To put that into some perspective for you, India's overall GDP growth during this particular time period was around 9%. So rural incomes have actually grown at a slightly faster pace as compared to the national average. But as with any other story, there is a catch here as well. Expenses in rural households have surged even more dramatically. Between 2017 and 2022, like we've been talking about, average monthly household expenditure shot up by 69%, and this outpaced income growth. What is notable here is that more of this spending is now going towards non-food items. In 2017, households were spending about 51% of their income on food, but by 2022, that figure has now dropped to 47%. So the next and possibly obvious question is, with rising expenses, what is exactly happening to savings? Look, surprisingly, savings are also increasing. In 2022, 66% of rural households had reported saving money as compared to just 51% in 2017. And it's not just more number of households saving, they are also saving more amount of money. The average financial savings per household rose from 9,104 rupees in 2016-2017 to 13,209 rupees in 2021-22. So how are people exactly managing to save more while they are also spending a little more? Look, this shift is largely due to changes in financial behavior. A lot of it is driven by the pandemic. To give you context, the uncertainty caused by COVID-19 made people a little more cautious about their finances, which eventually led to a rise in precautionary savings. But at the same time, with expenses outpacing income, many households have had to rely on borrowing in order to cover this gap. Access to credit during this particular time frame has improved quite a lot thanks to schemes like the Kisan credit card and other institutional loans. The survey also found out that average borrowing per household also slightly increased from 36,900 rupees in 2017 to 37,200 rupees in 2022. But what is even more interesting here to look at is where exactly this borrowing is coming from. See, there has been a very clear shift towards formal credit sources. Loans from banks and other institutions have been rising, while borrowing from informal sources like moneylenders has dropped quite significantly. This is suggesting that rural households are now becoming a little more financial savvy and are starting to use formal financial products a little more confidently than they were ever using before. So to sum things up, rural India's financial landscape today is evolving in ways that may not be immediately obvious. More households are turning to agriculture, but at the same time, they're also relying heavily on non-farming jobs for their main income. Rising expenses are being managed through a combination of borrowing and smarter financial planning, which is allowing many households to save more despite higher costs of living. Improved financial literacy and better access to formal credit are also helping households navigate these changes. But that said, whether or not this balance can be sustained in the long term is still a question that needs to be answered. With that said, let's move on to the next story and talk about a recent interview that investor Stanley Druckenmiller gave, which has been getting a lot of attention in financial circles. To give you some context before that, Druckenmiller is not any ordinary investor. He has been incredibly successful for the last 30 years without a single losing year. And because of the kind of success he has had, whenever he speaks, it holds a lot of weight. Now, in his latest interview, Druckenmiller shared some very big concerns about how the US Federal Reserve is handling the US economy. To understand why, we need to take a look at what the Fed exactly has been doing over the last few years. See, when COVID-19 hit in 2020, the US economy was in some serious trouble. Businesses were closing, people were losing jobs, and things were looking quite bleak. The Federal Reserve stepped in quickly by cutting interest rates and pumping trillions of dollars into the economy in order to keep it afloat. Druckenmiller agreed with these actions at that time, and he thought that the Fed did a great job of helping businesses and families survive the crisis. But here is where things get tricky. Druckenmiller believes that by 2021, the Fed should have started pulling back. The economy was recovering, but the Fed kept interest rates low for way too long, and now he thinks that they've trapped themselves in a very difficult situation. One of the key ideas that Druckenmiller discusses is forward guidance. Now, to give you some context, forward guidance occurs when the Fed gives clues to the public and the market about what it exactly plans in order to do with interest rates in the future. Businesses and investors then pay close attention to these signals so that they can adjust their plans based on what they think the Fed will exactly do. Now, in his interview, Druckenmiller argues that the Fed has become way too dependent on forward guidance. Instead of making decisions based on what is actually happening in the economy right now, they're sticking to these promises even though they did not make sense anymore. Now, fast forward to today, Druckenmiller says that these things are still very concerning, but this time for very different reasons. See, the inflation is higher than Fed would like it to be. It is hovering between 2.5% and 3.25%. The Fed has responded to it by raising interest rates where they're hoping to slow down the economy by making it more expensive to borrow money. Their idea is that when borrowing gets a little more expensive, people and businesses will spend less, which should help lower inflation. But Druckenmiller thinks that this is not quite working for the US. He points out that the economy is still going very strong. Stocks are rising, gold prices are hitting record highs, GDP is above trend, and even cryptocurrencies are doing well. So all of this suggests that the economy is not quite cooling off despite the Fed's rate hikes. Meanwhile, the Fed has already cut interest rates by 0.5% and has also hinted that more rate cuts could be coming soon. Druckenmiller sees these very signals as a big mistake by the Fed. According to him, by signaling these rate cuts, the Fed might be acting a little too quickly and also in the wrong direction. To explain his point a little further, he also brings up the 1970s during his interview. Back then, inflation was a big problem, just like it has become today. This was a point when the Fed eased up on interest rates too soon and inflation came back even stronger eventually. In the late 1970s, Paul Volcker, who was the then Fed chairperson, had to raise interest rates to nearly 20% to bring inflation back in control. It was a very tough time for the economy, but it was also necessary to fix the problem back then. Now, Druckenmiller is not quite saying that we'll exactly see the same thing right now, but his worry is more on the lines of the fact that Fed could make a very similar mistake by easing things up too soon. Druckenmiller in his interview also then touched upon the upcoming US elections. While he's not quite focused on politics, he believes that the market seems to be expecting a Donald Trump victory. He says that rising bank stocks, climbing cryptocurrencies, and other stocks that tend to benefit from deregulation are all signs that investors are betting on a Donald Trump victory. In the interview, Druckenmiller also spoke about AI and an investing mistake that he had made recently. He admitted that he had made a mistake with Nvidia and he sold his shares after the stock price tripled, which he thought was overvalued already. Today, the stock is even higher and he acknowledges that he made a misstep. But he says that he still believes in AI and he is now focusing on investing in the infrastructure behind its growth. Finally, in the interview, Druckenmiller also spoke about his next big bet, which is betting against bonds or basically shorting. For a simpler understanding, he expects bond prices to fall, which would cause bond yields to rise. His thinking is if inflation keeps going up, bond yields could jump very significantly, and even if the Fed is right and inflation does not quite spike, Druckenmiller feels that the downside risk is very small. So he's basing his move on the idea that the 10-year bond yield usually follows the trend of nominal GDP, which is currently at around 5.5%. With that said, let's move on to the final section of the day, which is the small news tidbits. First, Ambuja Cements is acquiring a 46.8% stake in Orient Cement for 8,100 crore rupees. The price of this is 395.4 rupees per share. Now, this move will boost Ambuja Cement's market share and also bring its capacity closer to 100 MTPA by FY 2025. Second, PB Fintech subsidiary has received an approval from the RBI to operate as an account aggregator. This will help expand its fintech offerings and also strengthen its positions in India's financial ecosystem. Third, Hyundai Motor India's shares listed at a 1.3% discount despite a strong demand from institutional investors. But despite that, analysts are optimistic about the company's long-term growth potential. That's all the news and stories I have for you today. I hope you found this episode valuable. Do let us know in the comments below whatever you think, your feedback, and anything else you'd like us to improve upon. I hope to see you in tomorrow's episode. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.